Nick, thanks so much for taking time out of your day and joining me. Great to be chatting, and would love to just dive in and hear a bit of your kind of background and career journey.
Yeah, pleasure. Good to be here, Dan. So my career journey and background. So currently I'm a investment manager at a Perth-based fund manager called Ingwe Capital. We specialize in real estate investment funds management, capital advisory, and occasionally property development. In terms of my career, I started probably close to 15 years ago at Computershare here in Perth, so in their registry division. So at that point in time, I
Yeah.
was handling listed company registry services and corporate actions for a number of UA ASX listed companies. After a period of time, I moved over to Melbourne, to their head office in Abbotsford, and was there for about a year before looking for my next challenge. At that point, I was lucky enough
Mm.
to be offered and accept a role with MaxCap, a group which is one of the
Oh,
larger non-bank lenders in the private credit. I spent 7 years at MaxCap from 2017 until mid last year. Started as their investor relations manager. I came in to build out that functionality within MaxCap as it was growing at that point, much like the private credit industry. And then post COVID, moved
mm.
home to Perth from Melbourne as the WA state representative for the capital raising team. Yes. Yeah, the majority of
Yeah,
my
nice.
last 7 or 8 years, or close to 10 years experience, has been in private credit and non-bank lending. So yeah, it's been a long journey, and the industry's changed a lot in that time since
Yeah.
I joined in 2017. So it's hard to believe it'll be coming up to a decade soon.
Mm. Mate, was the move back to Perth just purely COVID inspired, trying to get away from the lockdown?
Pretty much. So my wife's also from Perth, and we'd been over there for 6 years. She'd been over there a little bit longer than I had, and we had always planned to come back to Perth. If COVID didn't happen, we probably would have had an extra year or so. But
Yeah.
after lockdown 1.0, at the time she was working in outdoor advertising. So as soon as they basically locked down the state for JC Co and no one was going outside, they were like, "Yeah, cool, you're out. Sorry." She was made redundant, and yeah, she didn't really have a job for that whole lockdown period because there was just nothing happening and so much uncertainty in Victoria. So,
Mm.
um, yeah,
Yeah.
when we were getting towards the end of the year, Perth was obviously living it up in paradise, like everything was fine. And she'd been searching for a job that whole time with no avail. I said, start looking in Perth, and I'll speak to MaxCap about moving to Perth office and doing my job there because I've been doing it remotely
Mm.
for 9, 10 months at that time. And within a
Yeah.
week or two, she had a job offer over here in Perth. So
Wow.
I went to my boss at the time, which was the then COO of MaxCap, and he was supportive of my move across, given that there was no sort of detriment to the investor experience from me working remotely. So what was the difference being in WA? And then there was also a good synergy um, in raising capital from WA investors because we didn't actually have a capital raising presence in the state at that time. So
Yeah.
it all worked out well. We drove across the Nullarbor with the dog at the end of 2020. And then I think, just as Mark McGowan opened the border, and then I think it was February, late February, that it shut again and Melbourne was in
Yeah.
lockdown for another year. So we really crushed that timing. And
No.
yeah, I felt really bad for most of my investors and colleagues who were like, I can't believe you got out. So yeah, it was,
Uh,
we've loved every minute of being home. We're very much beach people and Perth people. So it was a good
yeah.
period in Melbourne, but nice to be back in the motherland. So,
Nice, mate.
yeah.
Nice. And you mentioned the rise of kind of those private credit markets, how you got into max cap. What's happening in that space driving that real surge? in private credit and private markets?
Yeah, so I joined Max Cap and private credit. I really had no real background or any insight into the asset class when I joined. It was totally new to me. So that was October 2017, and it was probably
Yeah.
still a fairly immature market at that time. You still had the Banking Royal Commission that was either in process. I don't think it
Mm,
had finished by then. That was 2018, but you sort of had this
yeah.
private credit market in my industry, which was commercial real estate debt, um, come about, driven by a combination of APRA um, basically telling the big four banks that they had too much of a market share in the property lending space. I think it was somewhere up around 90%, and they said, you guys have got to
Wow.
pull that market share back to, I can't remember exactly what it was, but let's even say it was maybe only back 5% or so, 5 to 10%.
Mm,
And that funding cap between the borrower demand and what the banks were allowed to offer to APRA at that time was somewhere around $50 billion.
wow.
So, yeah, in
Wow.
slotted your companies like MaxCap, which at the time was probably one of the smaller players in 2017. You would have had your Qualitases and Wingates and Balmains, I think, around that time in terms of the
Yeah.
specifically real estate debt market. But yeah, in 2017, MaxCap would have, I think that financial year had about 700 million in FUM. And now,
Wow.
8 years later, we're talking that they're somewhere around 6, 7 billion. Um, so that
Huge
is just
numbers.
massive. And I suppose not only to sort of round out that combination of APRA, you also had investor appetite for alternative investments outside of your standard equities and direct
Mm,
um, equity investment. So I suppose the
yeah.
commercial real estate debt in particular was attractive to investors for its ability to generate reliable income streams while mitigating risk. So that was quite good for investors in times of uncertainty in other markets like your equity markets. So when you mention, I
Yes.
guess, the explosive growth in it, I reckon that probably came about more so post COVID. um, I think about what I
Mm,
really think about is as we led up to COVID 2019, 2020, the asset class was becoming more well known and players were starting to come into the market. And with interest rates at near historical lows, um,
mm,
the pricing that we're able to offer investors was becoming less competitive than if they put it in equity markets. We were only being able to offer sort of
yeah.
single digit returns for a 65% LVR first mortgage, let's say, maybe 7, 8%
Yeah.
at the high end. And investors were a bit bored with that and thought, you know what, I'd probably prefer a bit more risk and just put it into the equity markets.
Mm,
And then, especially more so when we had COVID in 2019, 2020, and initially it was obviously a tough period, and everyone was freaking out of the world collapsing. But once everyone
mm,
realized it wasn't, and you had global quantitative easing just
massive.
smashing money into the market, um, you know,
Massive.
people were, yeah, yeah. So that firstly, I guess, led people to go, I want to move away from this and go risk on in markets because everything's pumping.
Mm,
But then when that sort of valuation started going through the roof and we started seeing a bit of a shift to end of quantitative easing and interest rates starting to increase, that's when you had the real tailwinds of debt for commercial real estate for sure. Um,
yeah.
so it's really
Yeah.
enjoyed its time in the sun and is still seeing those tailwinds. So it's probably been at least, yeah, 3 years where it's risk adjusted returns pretty hard to beat.
Yeah. And I guess on that, you're raising pretty much purely from kind of high net worth individuals, family offices, people with fairly significant kind of wealth. Where are you seeing them allocate kind of right now? Like a lot of this was sort of Melbourne focused, but I know there's been a little bit of a shift away from that. Kind of what's happening right now where people are looking to allocate.
Yeah, I think it's a super interesting time right now. Sort of as I just mentioned, you've had these tailwinds of the rising interest rate background the last, let's say, probably three years almost
Mm.
that they've started going up until now. And during that period, it was pretty much put your money into any real estate debt product in sort of most sectors and geographies, and everything's rosy. Like,
Yeah,
don't even worry about it. Valuations are rising, everything's sweet. And
yeah,
then 18 months ago, 12 to 18 months ago, I suppose on the East Coast, you started seeing tops in, firstly, I would say the fringier markets in the East Coast, your Byron Bays,
yeah.
maybe Geelong, those secondary markets are where you first feel it. And now in the last 12 months, we've sort of seen New South Wales and Victoria in particular have sort of reached their peak and came off quite a bit. So you're really starting to see investors be a lot more picky and choosy than what they used to be. And they need to be.
Mm.
So usually when I think of
Yeah.
allocations, we always split it. It's easier to split it between asset class, sector, and geography to get the best snapshot of sort of where investors are going. So, um, first mortgage debt still massively the number one sort of area that most investors are looking to allocate.
Yeah.
Um, as sort of sectors. Land is always good. Doesn't sort of matter where it is, it holds its
Mm.
value pretty well. Got no construction risk, which has been a massive issue in all sectors over the
Mm.
last couple of years. Industrial, super hot. Um, Really hard to get a
Yeah.
good deal. Valuation's pretty high, but 2019 onwards, 2019 is probably when industrial started to get really hot and some great deals were had and the best returns there.
Mm.
Now it's a much tightening market and investors
Yeah.
love it if you can get it, but you've got to compete with the banks now. The banks will go, actually, we'll do industrial because it's awesome.
Yeah.
So you don't see as many, they don't have to pay the private credit rates outside of industrial. Large format retail in terms of first mortgage
Yeah.
construction is outside of industrial is still quite well liked. Easy to build in and out quite quickly. First mortgage construction, residential, you're
Yeah.
still seeing people a bit wary of that with construction risk and materials
Mm.
cost, labor shortages, builders obviously a massive issue on
Yeah.
not just on the East Coast, but the West Coast. And then office and hotels are the ugly stepchildren of the industry still. I think yeah, what's interesting now is they've had such a bad run for 3 years, and you've started to see East Coast valuations come off so bad. The sentiment is so low that
Mm.
surprisingly, I've started to have a couple of more sophisticated high net worths starting to look into that space,
Wow.
into these depressed assets in
Yeah.
office in particular, which kind of blew me away. And I suppose their sort of thesis on it was they get shown a lot of first mortgage debt deals for land, whatever it is, and they're going, yeah, okay, valuations are getting pretty high. If we're looking at an investment horizon of a longer term, the risk reward for a first mortgage on something with quite a high valuation in a market that in Perth is sort of probably reaching the top of its cycle. In Sydney and Melbourne, it's
Mm.
already reached and is getting down off its top. Maybe we look to something that's depressed at a lower valuation and look at it
Yeah.
over a 3 to 5 year time horizon and go, actually, there's probably less risk in getting something there in an equity basis from a return perspective than holding a first mortgage that's highly geared and could actually come off the boil, and you're left in a not as good a position for only a 10% return per annum.
Yeah,
So
I've
that
definitely
was that
been.
was probably those conversations were some of the more interesting ones I've had that have, I guess, gone against the grain of where most people are happy allocating, which is shorter term, so 12-month first mortgage debt with a little bit
Mm,
of mezz sprinkled in there to bring the overall portfolio return up. Equity in terms of asset classes, equity, yeah, most people have been pretty wrecked over the last couple of years. It almost doesn't
yeah,
matter. Industrial, again, is probably where equities, you've been able to get those returns, build a few warehouses, sell them off. It's easy. It doesn't take as long. There's
yeah,
appetite for it. Gee, if you've been
yeah,
in equity in office or hotel or probably resi with these rising interest costs, delays, valuations peaking and coming back, they've
yeah,
just been so punished. So I think the majority of my investors, unless they're really familiar with the space and property in general, it's just a flat no. They don't need
yeah,
the risk. They're happy to play defensive at the moment while there's still some uncertainty and you've got interest rates being unpredictable and maybe coming down more or less. And you've got probably global uncertainty with the change in power in the US. Yeah, it's a really interesting time in terms of changing allocation mixes after probably 3 years of debt just absolutely being the
yeah,
king and having the lion's
yeah.
share of everyone's sort of real estate portfolio.
Yeah, Donald Trump, the giant wild card in global politics at the moment, which is always fun. But I was going to say I've had a few clients of mine actually in the equity space starting to talk about possibly going back into offices. They're starting to look at some different deals in that space, which I'm finding interesting. And their play is really office can't go any lower, and there's a
Yeah.
big sentiment to get people back in the office right now. There's kind of every day you'll find another news article on the feed of this organization, that
Yeah.
organization, this government body saying, hey, we got to get people back in the office 4 days, 5 days. I think Peter Dutton came out with his policy around, get everyone back in offices. Too many public servants,
Yeah.
possibly taking it a little bit too easy at home. So I think office is going to be an interesting one on that sort of horizon you were talking of, maybe 3 years.
Yeah. Yeah, I think so. And I think just the way Australia is so reliant on property outside of mining, it's becoming almost an industry that's too big to fail. And this is one
Yeah,
way to mitigate that. And those big players, yeah, they can't sit empty. And you're right, some of the more savvy investors probably can catch the falling knife quite well, so to speak.
yeah, yeah, yeah,
Because yeah, there's going to be a time I think when turns around, and
yeah,
it's probably sooner rather than later. And a lot of these guys are happy to sit there if they're underwater for another 12 months, let's say, knowing that there will be a turnaround, especially when, as you say, you've got Peter Dutton or various forms of the government pushing to have that happen.
yeah, yeah. Mate, switching gears a little bit, how are you finding technology, be it AI, be it blockchain, anything in that kind of world? How are you finding that starting to impact funds management?
In my sort of area, which is more focused on the capital raising aspect of investments, haven't seen too much impact from AI. I think it's probably one of those areas where you need the human touch in comparison to your coding and analysis and things like that, where if it's maths and theory driven,
Yeah,
anything theory based or sort of written, you're going to get just more and more powerful AIs that are able to grab information, even if it's your information, make it pretty, work on those economic theories or transactional feasibilities, things like that, and just make your work a lot easier. And I think in terms of AI, the last bastion of pre AGI and sentience, let's say, is when it becomes human. And yeah,
yeah,
investors want that human touch. They want to be able to, they deal with people that they trust. It's more so
yeah,
about the people than the actual business that you work for. I switch businesses to Ingwe relatively recently, and I've had investors that have moved across to work with me and invest with me because it's not necessarily about the deals. The deals you speak for themselves, and they're all always have a lot of risk mitigation and a proper credit process. But it's more,
Yeah.
who do they trust? Who can they pick up the phone and speak with? And I suppose you ask anyone if they're calling a robot at Telstra or whoever to their bank to get something done, and it's probably like top of everyone's most painful experience is not being able to deal with a person, no matter how smart and how often they can pick up your words. It's never perfect. So
Yeah.
I suppose I'm lucky in that regard that I might be the last bastion of
Yeah. Yeah.
potentially
Yeah.
having a job. I think there's probably a lot in terms of technology and potentially AI, a lot of merit in sort of the banking area of it. And we do a lot of funds
Mm.
reconciliation and move a lot of funds of having people's money come in and then go out for loans. I think tokenizing
Yeah.
payments, just any sort of technology that allows for more secure transfer of funds is something that I
Yeah.
think is going to be big and should be quite a big topic for change.
Yeah.
And I would love if I had an AI or an easy way to do all that sort of stuff and just keep it secure and stop people from having to worry about putting in the wrong bank details or getting a scam email telling them
Yeah.
to money here or there. So I think that would be nice if
Yeah.
Elon, Elon and Sam Altman are listening to this on LinkedIn. Thanks.
That's it. That's it. It's an interesting point you raise, though. Like in business in general, relationships are the great asymmetry.
Yeah.
You can have two businesses that look exactly the same on the outside, provide the fundamental same product. One product can even be superior, but if they don't have the right relationships to be able to either distribute it or package it up in a certain way or get it out to the right people, those businesses still win. And there's not yet that I've seen any way for AI to overcome that. And I
Neither.
think relationships also trump the great kind of battle for attention, where it's like, okay, you can use AI to create great ads and great this and great that and get it in front of people, but that's already such a crowded marketplace. AI is going to make it an even more crowded marketplace. But what
Yeah.
cuts through is a phone call from someone I know, a phone call from someone I
Yeah.
trust, an email from someone I trust. So I think it's going to be really interesting to see how the role of a relationship manager either becomes potentially more prominent or somehow AI rises to the challenge, maybe just straight up clones you, clones your voice, clones your likeness,
Yeah.
listens to you for enough times that it just starts to sound exactly like you and it just tricks people. And you're at the
Yeah.
beach somewhere and
Actually, no, the beach. That sounds good. All right. As long as we're getting paid,
it,
I can charge a fee for the AI to use my likeness or something, and then sit on the
yeah,
beach.
that's it.
That sounds good. That sounds fun.
And maybe we'll round off with talking about biggest challenges facing the industry today as you see it.
I think it'll probably be no surprise to anyone that's in private credit that the lack of regulatory oversight at the moment, sort of in the name of private, ASIC are going to be, they've already started putting it under magnifying
Yeah.
glass. Most people, you only have to pick up the AFR every day and you probably see an article about a non-bank with a poorly performing loan that's only been around for a couple of years, that's seen the tailwinds
Yeah.
and come into the market and thought, yeah, I can do this. Anyone can do this. It's pretty easy to set up, and it's the investors that are the losers. Yeah, regulators just don't
Yeah.
have the data, and they don't know where to look for it. There's not a framework and no reporting requirements, unlike your listed REITs and things like
Mm,
that. So I suppose it's a relatively new space in that regard. But yeah, I think it's necessary 100% and sorts the wheat from the chaff. The real shame is that there are going to be the dodgy providers out there where investors are going to be the losers because you've got guys syndicating loans. The
Yeah.
fund manager doesn't actually have any skin in the game, and they've just pulled investor funds together. So I think the more
Yeah.
transparency, the more sort of oversight for credit decisions, risk management, valuation policies, and conflict of interest is probably a big one too. The better, because yeah,
Yeah.
it'll allow the companies that are doing it properly to flourish and not have to worry about a flood of, I suppose, cheap capital cheapening the market, but just structured really poorly
Mhm.
with higher risks. Yeah, so you've also had, I guess, these big non-bank players that have had acquisitions of part or all of their business by these global partners, and in this
Yeah.
changing nature of certain sector geographies over the last year or so, they're probably facing some significant challenges because your global
And
your global US giant invests in your smaller private credit firm in Australia and expects a return on their investment. And that means you need to write more loans to maintain your FUM or grow your FUM. And if the only loans out there are riskier loans, they're going to write them to make sure that their partners are getting the returns that they're expecting, which I think could further exacerbate the issues that you're seeing with non-performing loans from the bigger guys on the East Coast at the moment. So I think that's quite probably an understated risk, and something that's
uh,
probably relatively new, given that these global players are entering the Australian market really only with these acquisitions in the last sort of 2 to 3 years. So loans that are written back then when they've come in are only probably now coming up to their maturity, and you're starting to see issues and inability to
yeah.
refinance or exit. You're just getting non-stop extensions, and these are the things that
Yeah.
your ASIC don't have any oversight of.
Yeah. And it's going to be
Mm.
a tough. It seems like it's going to be a tough job for ASIC because they tend to use a hammer more than they use a scalpel, but potentially also doing it in a pretty challenging part of the cycle.
Yes, yeah. But yeah, I guess they don't look when everything's rosy and you don't have any investors kicking down the door going, look what happened here. Why aren't you doing anything?
Yeah.
Which is one of those things. Yeah, no,
Yeah.
everything's fine and not. Yeah.
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 Yeah. So, but look, I think it's going to be one of the biggest challenges. I think it's also going to be an opportunity for the groups who have been able to, implement some of this stuff for themselves and
Yeah.
kind of keep their nose clean and keep some of the conflicts out of their business model. I know there are some groups out
Absolutely.
there who this kind of thing could absolutely decimate, typically on the fringe of the industry, or people who have just seen, the potential for dollars and just chased kind of an opportunity where there was perhaps a lack of regulation. So I think it's good. I think it's due. It's just going to be interesting to see how it unfolds.
Yeah. And then the time it takes to
So
enact it. Um, yeah.
mm,
Yeah. Watch the space.
yeah, that's it. That's it, mate. Well, hey, Nick, thanks so much for your time and all of your thoughts and your industry insights, mate. I
Pleasure.
really appreciate it personally, and I know people are going to get a lot out of listening to those insights from someone who's been at the coalface for nearly a decade now, and that's a long stint in private credit these days to find someone who's been there for
Yeah.
close to a decade. So well done.
Thanks, mate. No,
And
pleasure. It's good to chat. Say it's all about those the relationships you build with people in our area, and we've obviously built that. So happy to have a good chat about an interesting area that I've now been in for so long.
you're a veteran, mate. You're a veteran.
Oh, I never thought I'd be here, but here we are. When I knew nothing when I started.
That's it. That's it. Awesome. I guess that's about it.